Hey everyone, welcome back to the Military Millionaire Club. So today I'm going to be going over entity structure and how you should set up your business to ensure you get the most out of your money and pay the least amount of taxes. Let's get it. All right, so first of all, you want to set up a trust. Now the trust is a living entity that you can pass down to family members, for, children, great-grandchildren, so on and so forth down the line, and they can continue to pass it on. Therefore, it never dies. That trust is going to own a company called an S Corp, a small corporation, a corporation of less than 100 employees. This is key, has to be an S Corp and not a C Corp. All right. Now every S Corp can own up to 100 LLCs. Now these LLCs are going to be structured a little bit differently. Each one of these is going to hold real estate. Now, let's say for instance, this one has $100,000 in equity. You don't want it mixed in with a house that has $10,000 in equity, because if somebody hurts themselves at this house, they can now sue you for the total amount of $110,000 of equity. So this is why we split up the LLCs. Now, if you have three houses that have zero equity, they're brand new, you just got them, then you can put them all in the same LLC. But otherwise, split them up. All right, so for now, for making this easy math-wise, we're gonna use $100,000 a year, okay, in passive income. So all these LLCs are renting out properties. All right, you're making $100,000 a year. That $100,000, the IRS says that you have to pay yourself a reasonable wage, which is about 30%. All right, so $30,000. Now that $30,000, because it's a passive income, not an active income, you are getting taxed at a lower tax bracket at 15.3%. All right, so 15.3% of 30,000 is 4,590. Subtract that, your net after taxes is 25,410 after taxes. Now here's the big part. But Jay, what happened to the other $70,000 that was in the business? What happened to that? Well, check this out. So because it's an S Corp, that $70,000 that was left over can now be sent out to shareholders in the company. Those shareholders are you and you alone. So that $70,000 now just became $95,410. I'll write that down. $95,410 after taxes for your business, right? So you get to pocket out of $100,000, $95,410. That's kind of awesome. This is how the rich stay rich and the poor stay poor, because people don't have information like this, and we're giving this information to you for free. So how do you go about setting this up? You want to talk to an estate or an entity lawyer and get that set up. Usually you can do it through like a CPA and whatnot, but they usually charge a little bit more. And if that's all you have locally, then go ahead and do that. But this is big. So how this money is sent out is called a distribution. It's a distribution of profits, and that is sent out. Because it's a distribution amongst shareholders, there's not a FICA tax against your company, so your company won't pay any taxes on it. For instance, if you own a McDonald's and you pay a worker $15 an hour, you're gonna pay them $15 an hour plus taxes. They're gonna pay their taxes out of the 15. You're also gonna pay taxes. So for instance, if you're paying someone $1,000 every 2 weeks, you're going to be writing a check for about $1,200 to $1,300, right? Well, because of the distribution, you're only going to write that check for $1,200, and that means that yes, you yourself will pay taxes on that 95 at the end of the year, but the business won't. So that saves you about 20 to 30%. All right. So if you have any more questions, make sure you reach out, start your business, get in that real estate investment, and let's get it. Boom.